Let me put that question to you. JPMorgan coming out with loan loss provisions, a pretty stark amount, but at the same time buying those $30 billion in buybacks, or I should say authorizing a plan to do so. How do you square the two?
Sure. Thank you for having me on the program. The provision was higher than expected, no doubt about it. And it was driven, as you guys just mentioned, partly due to what's going on over in Russia and the Ukrainian war. But they also had to just build reserves based on the new accounting methodology that all the banks have to use. And so they have to take a look at life of loan losses. And in doing so, they built up the reserves because when you think about what the world was like when they announced their fourth quarter results in January versus what it was at the end of March, it has changed dramatically. And so it's very natural to boost up the reserves in that kind of change. And so as we go forward, they did talk about, the possibility of a recession increasing versus what it was at the end of December as well. So that was the driver on the provision. The authorization is what it is, an authorization. It doesn't mean that they're going to buy back their stock this quarter or next quarter. They just want to have it on the shelf so that there's no expiration to it. So if they want to buy back their stock a year from now, they can do it.
Gerard, the stock's down 3.2%. If today was a bad day for the U.S. banking sector, will tomorrow be worse?
Interesting question, because JPMorgan Chase, which is often used as the bellwether for the U.S. banking industry, they have a number of businesses that most regional banks, for example, do not have. Obviously, regional banks are not very large trading firms, and they don't have global businesses like JPMorgan Chase. I think the reason that JPMorgan Chase is suffering today has more to do with their capital ratios coming down due to the trading risks that were elevated, as well as counterparty losses that were trading partner losses that were elevated. And then more importantly, their bond portfolio has to be marked to market, and that reduced capital as well. So will that affect some of the companies reporting tomorrow? Yes, we have some very large companies, as you know, Morgan Stanley, Goldman Sachs, Citi, Wells. But on the regional banks like a PNC or a U.S. Bancorp, who are also reporting tomorrow, they're not going to have the same issues as what you saw with JP Morgan's capital levels in our view, and therefore they should maybe fare a little better.
Gerard, I want to talk about that trading revenue that you just mentioned. Sonali was also walking us through the fact that those continue to rise and rise, really a function of the volatility that you're seeing in markets. One of the bull cases, though, for the stock market in particular is simply that volatility is going to decrease as you start to see some of those shipping rates, the supply chain issues, the inflation pre-war kind of eased just a little bit. Talk to us a little bit about what that means for the banking sector. If you start to see volatility come back down, does that hurt some of these banks and their trading revenue?
It's interesting because there's good volatility and bad volatility. And, the unexpected volatility we saw in the first quarter was handled very well. But if we get into a normalized market or a more stable market, and you start to see the 10-year government bond yield stabilize and maybe come down a bit, you could actually see trading increase without that volatility as more investors become comfortable in going out and buying bonds. We also, any pickup in the ECM business, which, as JP Morgan pointed out, was down dramatically year over year, which everybody expected from the numbers that we could glean from the geologic data. And so if we see a pickup in investment banking, that could lead to further trading, and that could offset any slowdown in volatility. And so the net of it is that depending on where rates go, it's not necessarily, a negative for trading as we go forward.
This is a point that Sonali was making earlier. In Q1, VAR went up and went up quite significantly. So in order to generate the trading returns, you are having to take significantly more risk. Spreads are widening. As a result, do we need to think about the way that we value trading revenues differently if the bank is taking significantly more risk?
Wouldn't say that we would have to think of it differently for the long term, because eventually the VAR will come back down as the volatility declines and we get into more normalized markets. But if these markets that we experienced in the first quarter, and again, remember what it was like on January 1st versus March 31st in terms of volatility, if that kind of rate of change in volatility continues throughout this year, then you're right. I think the valuation of those revenues would fall. But if we get back to, somewhat normal, not like what it was in the fourth quarter of last year, but if things start to get a little better, then the VAR comes back down, and therefore there won't be as much of a discount on those revenues going forward.